The test that the law imputes and what the Tax Appeals Tribunal has routinely said is that the documentation you're supposed to keep is that documentation that is necessary to establish your tax position.
Information that is within the domain of URA or the domain of a tax authority like KRA. Whereas the law does not expect that the Commissioner General and his officers will sit there and look through all returns that have been done by taxpayers. It is impracticable, but that's what that's the standard that the law actually looks at. That there is a machinery that the Commissioner General has that the taxpayer does not have, that he should be able to look through these tax returns whenever they're being filed on time.
When it comes to value-added tax or taxes that are equivalent to value-added tax, and the value-added tax would have been paid on a cross-border transaction. So we are looking at two countries. The rights to tax that transaction from a VAT point of view, or the rights to collect the VAT on that transaction lies with the country in which the consumption is being made.
Good afternoon, everyone, and welcome to the Tax Hub podcast, a platform where we demystify complex tax issues in the Ugandan tax landscape, bringing them in a more vivid and clearer way to ordinary taxpayers. My name's Mbekeka Vanessa Irene Muneza, and I'll be your host today. I am a senior associate at AF Mpanga Advocates, specifically in the tax department. Today's discussion revolves around two pivotal rulings that have really stirred the waves around the tax landscape in Uganda. The first one being Kampala Hospitality Development Limited versus Uganda Revenue Authority. We'll be breaking down this case, the reasoning of the tribunal, the issues and the findings, and generally the most important, the impact of this ruling on your business as a taxpayer, as an individual, and to say the least. And the second case we'll be discussing is Premier Recruitment Limited versus Uganda Revenue Authority. So joining me today is a stellar panel of brilliant minds that are going to break down these rulings for us today in the simplest way possible. So I'll allow them introduce themselves, starting with Emma.
Thank you very much, Vanessa. My name is Emmanuel Tumuhaise. I'm a senior associate with Otas Advocates. I do tax advisory services as well as corporate and financial advisory at the firm. I'm happy to be part of this stellar panel and looking forward to the discussions that we have.
Thank you, Emma. You're very welcome. Moving on to Lucy.
Thank you so much. My name is Lucy Kemigisha. I am in the tax and regulatory department of KPMG. I hold a position of a manager, and in my work, I mostly do tax advisory and also corporate law advisory. When I'm not working, I will most definitely be reading a book. I'm very happy to be here.
Thank you for joining us, Lucy. Moving on to Alex.
Good afternoon to us all. My name is Alidechi Sali Alex. I have done practice for tax for probably considerable 7 years, and the other 4 years or 3 have been a balance of practice of other things. However, I lecture tax, law, and practice. I currently also work with URA and I've litigated a number of cases. Yes.
Thank you, Alex. As you can see, we're joined by very experienced, brilliant minds. So just to kick us off, I'll start with Lucy. With the case of Kampala Hospitality Development Limited versus the URA, can you walk us through the brief facts? What were the issues at hand and what were the findings of the tribunal in the simplest way possible?
Okay. So the case of Kampala Hospitality Development Limited versus URA, in summary, is about how far back can the Uganda Revenue Authority go to issue an assessment. What exactly happened was the URA carried out an audit on Kampala Hospitality Development. I think you'll allow me to abbreviate it as KHD. When they carried out that audit, they issued an assessment that covered the period from May 2015 up until December 2019. And that assessment was with respect to VAT. KHD, of course, argued, and it was not in agreement with assessment. And the reasoning was that, okay, you have issued this assessment. However, this assessment covers a period above the 3 years that you are supposed to cover. So KHD was claiming or arguing that, you know what, in your audit or in your assessment, you should have only considered a period of 3 years. And this assessment was issued in January 2023. So KHD would have been okay with the 3 years before January 2023, but was not okay with the period from December 2015 up until, rather from May 2015 up until December 2019. URA, of course, claimed that they had found new information, and that it was on the basis of finding this new information that they issued the assessment covering the period exceeding the 3 years that they should have looked at. KHD objected to the URA. The URA, of course, declined their arguments. And then KHD, as it would naturally be, went to the Tax Appeals Tribunal. And in the Tax Appeals Tribunal, the same arguments were actually put across. KHD was indicating that URA should have only considered 3 years from January 2023, and it shouldn't have gone far back from May 2015 up until December 2019. URA indicated that it is indeed correct in the law that they're only allowed to audit a period of 3 years and issue an assessment to that respect. However, there are exceptions where they can go back. And they put across 2 exceptions. The first one being that they found out new information. And this information was pertaining to the withholding tax returns that had been filed by KHD. And also they went on ahead to argue that by KHD not paying the VAT, or by not filing the returns of VAT, they had willfully neglected their obligation. The tribunal was not in agreement with the first ground of URA. The tribunal felt or ruled that since the URA already had the withholding tax returns in their system, the claim that that information was new could not stand. Their understanding is that new information means or includes information that has not been disclosed before. So the tax authority had this information in their system from 2015 up until December 2019, so they cannot claim that that is new information. However, the tax tribunal agreed with them when it came to willful neglect. And the basis was that KHD had invested over 1.7 billion Uganda shillings in Uganda. And they had also filed withholding tax returns. The withholding tax returns had information pertaining to imported services. The VAT assessment that was issued by URA was with respect to imported services. So by them filing withholding tax returns, there is information about imported services. They cannot say that they did not know, or it cannot be said that they did not willfully neglect to account for VAT on imported services. And the tribunal actually indicated that it wasn't convinced that it was an honest mistake for KHD not to account for VAT on imported services. So all in all, we are looking at the tribunal tackling the issue of the exceptions to limitations, the limitation period, and it came out outright to indicate what exactly amounts to new information. It also actually extended and expounded on what exactly is willful neglect, because now it turns out that if you have an obligation in the law, and it so happens that you have filed a return and there is information in that return that could have led you to have that obligation, and you do not carry it out, it could be construed as willful neglect. Thank you.
Thank you, Lucy. I think that was very insightful. What comes out clearly is the law prescribes a 3-year period, but there are exceptions to that 3-year period, which she has elaborately discussed. So I just want to pick Emma's mind on this. The URA stated that they discovered new information. One would ask, what exactly entails information that taxpayers should keep? How long should they keep it for? And are there any exceptions to that time period?
Okay, thank you very much, Vanessa. And this case goes to the heart of essence of keeping of documentation when it comes to tax matters. At the heart of every tax dispute, whether you decide to follow the dispute resolution process and object or even go up until to the Tax Appeals Tribunal, very key and pertinent is that you must have kept proper documentation for purposes of supporting whatever position you have as a taxpayer. And very important is that when it comes to tax disputes, before even before the Tax Appeals Tribunal, the burden of proof lies with the taxpayer to prove that whatever URA assessed is not due and payable. The only evidence that you would be able to adduce to that effect are the documents, or one of the key pieces of evidence that you'd be able to adduce to that effect are the documents that you have kept over time. So the test that the law imputes and what the Tax Appeals Tribunal has routinely said is that the documentation you're supposed to keep is that documentation that is necessary to establish your tax position. So there isn't a specific type of document that you're supposed to keep per se, but those that we have seen in practice usually being requested for by URA are items such as bank statements. Very important because they're able to establish any income and any expenses that you have incurred during that period. So if you're in business, any documentation pursuant to your commercial transactions is very important. So any invoices that you issued out, any invoices that you received, if you issued out any receipts at the point of receiving payments, those are very important and must be kept. And maybe what I should emphasize also is that we are in a digital age, so it is very okay for you to keep this information in a digital format if you so wish. In any case, it's a better way of preserving that information. Now, what is also important to know is that the law mandates you to keep this information for a period of at least 5 years. So what that means is that from the point you filed or from the point the transaction happened, you are obligated to keep these records for a period of 5 years. So that implies that if a dispute were to happen and you are required to provide this information, your defense cannot be that you no longer have that information if it is within a period of 5 years. But conversely, that also means that if it is beyond 5 years, then you may not be required to have kept or to produce that information. As a matter of fact, the tribunal has pronounced itself in that regard. Now, that's not necessarily a hard and fast rule that you must keep, or if you don't have that documentation post 5 years, then you are in the clear. Because, like you have indicated, there are exceptions to that to that rule. So, assuming an audit has happened or has commenced before the 5 years have lapsed, then at that point the time stops running. So, what that means is that you can no longer rely on the defense of limitation of time, that I'm no longer required to keep these documents beyond the 5 years. Reason being that at that point you have been put on notice that the Uganda Revenue Authority is looking into your is looking into your affairs. So if, as an example, the audit being done by URA is a VAT audit, and they've specified the periods that they're looking at. So what that means is that you're obligated to keep the records in respect of that affair that URA is looking into, even beyond the 5 years. So if then it goes on to the Tax Appeals Tribunal, and then you go on to whichever other body you want to appeal to, that means the time period will have been arrested. So what is key and what is important to take out of this is that proper documentation can be your friend. Oftentimes, you will have clients who will indicate that either they kept this documentation recklessly, or in certain instances, they did not even keep any documentation at all. Instead, some of these contracts were concluded by word of mouth. So in time, it might look like a good idea, but where a dispute arises subsequently, then you will be stuck and you will not have any evidence to be able to support the position that you want to put forward. Yes.
All right. Thank you, Emma. That's very, very, very helpful. All right. So moving on to Alex, from the regulator's side, from the URA standpoint, would like to have a practical understanding of what factors usually trigger issuance of assessments beyond a 3-year period. Yeah. So technically, in the case that Lucy has discussed, URA said they discovered new information, but they had these returns from 2015. Does this really amount to new information? What are the factors that URA looks at to say, no, actually, whereas maybe we did not notice this in 2015, or 3 years later, we're noticing it in 2021. How exactly does that dynamic work?
Thank you very much, Vanessa. But before I tackle your question that you've lowered to me, I would want to just make one single comment. And I'll compare this to certain jurisdictions. Giving an example of Nigeria, Kenya, South Africa, Singapore. If the audit that is being done, like Emma has been talking about, if the audit that is being scanned by the tax authority is probably for, let's say, 3 years. However, the information they are looking at in that audit, let's say the audit is touching 3 years, but the information they are touching on is going to relate back. It has tenterhooks that are relating back to 2 years, 3 years back. Yes? Then that information is deemed to be part of the subject period for the audit. That is very codified in Singapore, it's codified in Nigeria. Now, in Uganda, we don't have that kind of codification here that information would be. So it looks like for our tax laws, there is a certain cut through of a sword that says if it is 3 years, you can't go beyond that, and that is it, unless you fall into the exceptions that you're talking about. Now, the tax authority would not need the exceptions that are listed under our law if they could only make that connection between the information that they are looking at in a certain audit to the relevance of the one that is before. If I give an example, let me say imported services, as you say, but you have a contract that was signed back maybe 2 years back, and that contract actually reveals that this was simply an extension of an existing other contract. Let's say it was an addendum. So the 3 years was simply an addendum. However, the mother contract is something that dates back 5 years ago. It means that for me to understand the addendum for the 3 years, I would have to look at the mother contract, the sitting contract. So when you make that connection, sometimes you do not need the exceptions. if I can only fit within that square. However, that codification we don't have here. And that goes back to the point that our laws just simply provide for what is normal and expected. The detail is not there. When you read the codification of Singapore laws, they are very detailed. The US law on tax, too much detail, to the extent that they will tell you what you need to do, when, how do you do it. Now, for East Africa, it's still a bit lacking. Maybe when they do the East African taxation laws and they are codified and put together, maybe we shall get that bit of it all. Now, going on to your question. Practically, if I, as a tax authority, can lie within the exceptions, for example, I need new information for me to show that I can actually go back maybe 3 years or 2 years or whichever years I can go back, but I can show that there is some new information that has come in. You must be able to demonstrate that it is actually new information. Information that is within the domain of URA or the domain of a tax authority like KRA. Whereas the law does not expect that the Commissioner General and his officers will sit there and look through all returns that have been done by taxpayers. It is impracticable, but that's what that's the standard that the law actually looks at. That there is a machinery that the Commissioner General has that the taxpayer does not have, that he should be able to look through these tax returns whenever they're being filed on time. Now, whenever he does not do this in time or on time, then he has to demonstrate that there's new information. New information would mean that it is information that has never been in your domain. By domain, I mean by no reasonable spread of a web you would have gotten to get that information. If by any reason you could have gotten to know this information, for example, through a third party, if it is VAT, you cannot say that that information was not in your domain. I don't think it will be new information. Yet, the other supplier filed his returns. The purchaser also filed their return. That information is already within the domain of the Commissioner General. And in my view, I don't think even if the TAT was to face something of a sort that it would consider it as new information, because the information is already there with you. It is seated right there. The other exception that normally they want to look at and really hang on would be willful neglect. But willful neglect, you must first establish that there is a duty legally established by law, that the law is parting on to someone to actually hold. That duty must be there. Now, if you can't establish that there is a duty that I had to do a particular A, B, and C, and it's not there, then you cannot tell me that I willfully neglected something because I don't have the duty to do so. For example, in VAT, as a person who has sold something to, let me say I'm a hardware, and I'm selling wholesale. Oh, let me say I'm a manufacturer. I'm selling something to a hardware. If the buyer or purchaser, who is the hardware, does not file their returns and reflect me as a person who had given him or sold to him something, it is not incumbent on that particular person to actually tell you, oh, I also sold to this one and I sold to the other one. No. Because the VAT ring will actually get you, by you looking at the VAT trail, you'll be able to know who was the purchaser, who was the seller, who should I look at. All that information, you have it with you. So if there was a question of further information, as an officer seated in URA, I should be able to ask myself what is the further information. I should be able to fill it in. So the ground of willful neglect on the taxpayer is very hard to prove. You must establish the duty first. Now, in the instant case that we are discussing, I do not want to discuss whether the tribunal looked at whether there was actually that duty on part of the taxpayer. I will not go there. But however, the other ground that they normally want to look at is fraud. To establish fraud has been defined to mean anything that is dishonest. So it's a wide definition that anything under the sun might fit in as long as it is a dishonest act or representation of facts or misrepresentation of things. So For fraud to be in place, you must have done something that is dishonest on your part. I don't know whether mere silence of certain facts it could also come out to be dishonest. If probably under normal circumstances that information would have been needed, but you kept quiet about it and you didn't say it, then it would mean you've been dishonest about something. Even mere silence can mean that you are part of a fraud. In our jurisdiction here in Uganda, the issue of discussing maybe new information or willful neglect or fraud to a large extent has not been that much litigated. However, in Kenya, they have had several of those. And Nigeria, it is worse. It's almost the first escape route for everyone. Anyone wants not to pay tax, first, you're out of time. Now you have to grapple. So what the Nigerian revenue authorities have done is to always make sure that whenever they're issuing such an assessment, what comes with it are those particular grounds why they have actually assessed you. They would actually tell you immediately, you know what, this you kept quiet about this, you did tell us about this, and you neglected your duty about this. So by the time you get the assessment, you know why, and then you start gauging whether you can actually fit in or not. South Africa does the same because their laws are really defined and they have that detail, which we don't have here. So I think this is one of the cases that has gone through to actually have the whole idea of probably looking at new information and defining it. Several that have come up before, probably the parties have settled them and they have not gotten there. The last case that ever discussed the idea of new information was a discovery of new information. I think it was UETCL.
Yes.
But it was also just a judge talking about it in passing, and not necessarily that it was a facted issue that needed to be part of the judgment to make conclusions or ratio decidendi of that particular judgment. So this is the only case that has come up. I'm quite certain with it, probably an appeal will lie. And High Court can be given a chance maybe to give more grounding on the issues of dating back in time and being out of time or having new information or not having new information, or establishing the grounds of the exceptions that we are looking at.
Yeah.
Yes.
Thank you, Alex, for that. I think Alex lays out very pertinent benchmarks that maybe the policymakers can consider, providing more detailed legislation, and also to the regulator, being clear about the reasons why they are issuing a tax assessment beyond the 3-year limitation period. So since we are here and we're having this discussion, our viewers out there would like to understand, maybe from each of the panelists, how then can they protect themselves, or be found on the safe side of things when, let's say, that in light of this ruling, what advice would you give them on how best should they keep information? How best should they handle audits or assessments? Yeah, maybe I'll start with Emma.
Okay, thank you very much, Vanessa. So I always tell clients that in the long term, compliance will always be cheaper than trying to fight an assessment once you receive it. So from the word go, you want to make sure that you understand your tax obligations. You have accounted for how you are going to comply with those tax obligations. It's one thing for you to try and mitigate your tax exposure, but it's also a wholly different thing for you to try and deliberately decide not to pay your taxes. In the long run, that ends up becoming more expensive for you than if you decided to account for your taxes from the word go, or if you decided to pay close attention to your taxes from the word go. So Lucy and Alex have been absolutely clear, especially when it comes to the case itself. On the one hand, and this is what the tribunal said, and Lucy mentioned it, for the taxpayer to wake up and say they were not willfully negligent in not declaring the corresponding VAT was disingenuous. Reason being that when you receive an imported service, withholding tax always matches with VAT, right? So if someone has declared and remitted the corresponding VAT, but not declared or paid, rather the corresponding withholding tax, but not declared or paid the VAT, then it becomes extremely very difficult for you to argue that you are not negligent, or you did not intend for that to happen. So I think what then becomes important is, under what circumstances would you be able now to get away with it in the event that the 3 years have already lapsed? And like we have indicated, if your documentation is absolutely clear and you have kept it in order, and you have provided it as and when it has been needed by URA, and you made an honest mistake at the point you made your declaration, then you should be able to be safe, and you can use the defense of limitation of time ably. But I also want to touch on what Alex has indicated in terms of our tax legislation. I noticed, and one of our elders in the field, Mr. Cephas Birungi, always talks about the practice notices. That the last practice notice came from URA about 2018 or 2019. We're now coming to about 6 years or 7 years without a new practice not being issued by URA. In comparison, more developed economies like the UK issues guidance from time to time on how they might interpret certain provisions, on how they practice the tax in their jurisdiction, which is not the case. What then that where that leaves us as a country is that we have a very lean tax code, which then means that there are a lot of gray areas. There are a lot of gray areas which then causes disputes between the taxpayer as well as the tax regulator, URA. But if the tax regulator, well knowing that there is a possibility of having a dispute from such a gray area, were to issue guidance from time to time, and not just public notices, because the regulator has issued public notices from time to time, but issued practice notices, then I do believe that it would alleviate a lot of the disputes that we have with the regulator from time to time, because then it makes things more clearer. If you're having any issues with URA, from the word go with if you're correct or you're not correct. Yes, but when we simply leave them up to the tribunal and the courts to make a decision, and then we shall implement that decision at that point, well knowing that a specific area is gray, then it puts everyone at a disadvantage, both the taxpayers and URA, because you're expensing a lot of resources trying to defend that position. So for the taxpayer, keep your records in order, and you should be fine.
Yeah, thank you, Emma. Lucy?
Thank you so much, Vanessa. I think how the businesses can protect themselves, I look at it from two elements. The first element is from a tax advisor point of view, and the second one is from the actual business. For the actual business, I would want to advise on training the finance teams about tax. What exactly is expected of the business from a tax point of view? How can the business be compliant? What kind of reconciliations should be done every after a month to be able to actually catch these mistakes in quotes? Does the finance team that is actually handling the tax, in case maybe there's no specific tax team, does the finance team actually know what exactly to do, or they will just file the return and then they will leave it at that? The other bit is using technology to actually carry out reconciliations. I think we are in a period whereby tech is developing. And there are tools that can be used to actually run automatically monthly reconciliations. And I think that can be done without taking a lot of resources in terms of time and also in terms of human resource. The other one is periodic tax health checks. And this can be done by the business itself, or they can involve a tax advisor to actually carry out these tax health checks. After you have submitted these returns, are there certain mistakes that you could have done unknowingly, maybe because of the pressure of the timelines of filing of the taxes? Is there something that you have actually left out? And that can only be done through, that can only be found out through carrying out tax health checks. So it's not just about filing returns and you leave it there. Go back to your information, find out, did you do everything in accordance with the law? The other one is about the tax advisory arm. As a tax advisor who is advising your client, what value are you bringing to the table? Let's say the business has engaged you to actually do, let's say, monthly tax compliance, which in this case would be VAT if I am to use the KHD case. After you have filed the returns, have you looked beyond the value-added tax? Are there certain areas of concern that you have found out that you can actually inform the client about? And this can be done by simple reconciliation. As the tribunal indicated, withholding tax on imported services goes hand in hand with value-added tax on imported services. So as a tax advisor, when you are looking at the returns of the client or you are assisting to file them, and let's say they are withholding tax returns and you see imported services, have you caught it from the side of the value-added tax? So all in all, the best tax planning or the start of tax planning is usually tax compliance. Then the rest follow. And when I look at the KHD case and the expansion of the meaning of willful neglect, there is it's quite important for every business out there to actually go back to their tax records and determine, did they actually do the right thing? And then if they found out that they did not do the right thing and there is any tax payable, we currently have a proposal of amnesty. They could disclose to the Uganda Revenue Authority or even devise means of ensuring that it does not happen again in the future. Thank you.
Thank you, Lucy, for such practical recommendations. I'm sure they will be very beneficial to our viewers out there. Maybe moving on to Alex.
Thank you very much. Going back to the KHD case, right?
Yes.
Looks like the Tax Appeals Tribunal was trying to say that was it a feasibility study or something like that?
Yes, models, running models.
The models.
Yes. Finance models.
The finance models. I think really that's completely finance, and anyone can run whatever model they want to run. Yes? To stretch that, to take it to the part of willful neglect, it is a far-fetched thing. It is very far from, like, it must be something that is attached. Let me say, if a woman is doing their hair and they know they probably have to go with lipstick and they're going to have extensions, there should be such things that are of the same class around there of a woman really, making up. In this instant case, I don't think the study or the finance models were really part of the whole tax issue. I don't think they affect tax in any way. However, like you've talked about how if URA is to issue the additional assessments, definitely they must fall within the grounds. And if you've noticed in the law, for something to be additional assessment, it means there's another sitting assessment in place. Yeah. But we have had cases whereby there's an additional assessment and there's no sitting assessment. These things happen sometimes. So even for that additional assessment to be able to survive or to be able to stand the test of time, it must be that you must show that there was a sitting assessment, and that sitting assessment had probably an issue, or it didn't touch something. You're trying to correct it with this one. Things like that. So the purpose for which the additional assessment sometimes is issued is what the taxpayer needs to question. And the game might end even there. Why are you issuing another one? I think you had the time, you've heard of audits that are overlapping each other.
Yeah.
Absolutely.
And you've seen whereby some of the cases, the taxpayer is complaining about being the fatigue of having so
Audits.
many audits going
Yes.
on.
Yeah.
Now, the reason as to why they have certain sections in place and law in place is to make sure that there is a finality to tax disputes or tax audits or tax matters. That's why you have a time limit of keeping records of maybe 5 years. Now, if I don't keep them beyond 5 years, like you remember a case whereby someone said their records were burnt and they had
Yeah.
a police report, and the tribunal was like, oh, the records are not around, and therefore this
The lost lives were false.
yes, the assessment was somehow it didn't stand. Why? Because the records are not there and they were burnt. So what did the tax authority have to do? Make sure that probably the fire didn't exist and show that this person was lying. Sometimes those things are not going to help. It's all about keeping the records. But if a taxpayer is sharp enough to make sure that they're 5 years, even if it's just a day, and it tells you I destroyed these things and they're not here. The belief is that I think the draftsman was trying to say probably 5 years are enough for someone to come back and look at, as a tax authority, look at these things. If they have audited 3 years, they can probably go back 2 years. So ideally, the whole thing of an audit should actually be 5 years. Because that's what they're trying to tell you.
Yeah.
Whereas there is a limit for 3 years for issuing the additional assessment, isn't it?
Yeah.
Yes.
But they tell you can only keep records for how long? 5. What does that mean? That you can only actually be audited for 5 years. All I can say is, if I'm a taxpayer, I just simply say, I destroyed those ones 5 years were gone. All I have is for 5 years. So our law gets to speak something without necessarily saying it.
Yeah.
Yet, when you compare with those jurisdictions, the colleagues have been talking about, other panelists here, you notice that for South Africa, it is too detailed. If they are doing a certain audit in maybe 2023, and you know that the tenterhooks go back as 2007, then that means you have to keep those ones. For them, that's how they do it. Unlike us here. So for every taxpayer, definitely he either pays nothing, pays less, or he delays to pay. Whichever works for him still will work. As good as me saying my records got burnt and I have a police report in place and the records are not there, I'll end up paying nothing. Not because URA cannot actually prove its assessment and defend it, but simply because the person they're trying to bring it against is saying those records are not there. So even if I give a default assessment, which is just from the Commissioner General's view of this business probably is making this much, he probably presumes chargeable income, he compares it to other different stakeholders or other businesses within the same industrial complex, and then he's probably going to tell you pay like 2 billion. But if those records are not there, then even that assessment will not be able to be supported at the test where it is before that. So a taxpayer should probably have their records set out clean, and if it is a relevant document, definitely you have to keep it. And also lately, like Lucy has said, the technology has come. So keeping of these documents, as people have cloud. If you need something like from a South African company, probably they will send you a login, and you log in to somewhere where they drop everything. I've had to try certain cases like that. Actually, I think we're doing that. Some of those cases with Lucy, whereby, and Vanessa here, they drop something and they tell you, you go there and look for it. It is in there anyway. You find it there. Lucy has mentioned about tax advisors. Yes, the taxpayer should choose a good tax advisor that is going to be able to advise him. Otherwise, if this additional assessment comes and the tax advisor has an idea, definitely you're going to end up being hung for no reason. And I think, whereas it is a funny argument to bring that my records go to bad, but sometimes I sit down and I'm like, this tax advisor was sharp because he found something to hang on, and he didn't even attack. When you read that case, the person did not even attack the viability, sustainability of the assessment. For him, he just pleaded, I do not have the documents. So if you have them, bring them. But me, they got burnt. My evidence is here. And that just fell out of law. Yes.
Yeah, thank you, Alex. That has been quite interesting. So what comes out clearly is there is still need for modification in our laws. Yeah. Considering the several benchmarks you've all mentioned summarily, but I'll just like to give 1 minute to each of you to propose, because the reason why we do this is also one, to create awareness, obviously, to taxpayers, whereas you definitely need tax advisors, but it's also necessary that you understand your rights, you understand your obligations, right? But even for our policymakers, our legislators, to have it from a practical standpoint of what things can they do better to improve these laws, to encourage compliance and avoid, having taxpayers have very heavy assessments. So we start with Emma.
Okay. Thank you, Vanessa. And that's important. And for me, why it's key, when it comes to tax, our regulators are an administrative body, right? The Uganda Revenue Authority is an administrative body. So what that means is that they have an obligation, they have a duty to be judicious in how they conduct their affairs. So they need to be fair, they need to be judicious in how they administer our tax law and how they implement it. Now, time and time again, if you talk to any tax advisor or any person who has dealt with URA from time to time, they will tell you, at the very least, I've encountered a scenario where the regulator, for lack of a better word, has made an unreasonable request when they do so. And sometimes, whether it is as a result of tight targets that come from the Ministry of Finance or for other reasons, you also find instances where officers in URA are really trying to push away a particular issue from themselves. So without treating the taxpayer fairly, without being without having regard to the circumstances that you have. If years ago I dealt with a dispute where a person requested for client statements, your officer requested for client statements for even more than 10 years, or trying to rely on the leg that Alex mentioned, that one document had an impact on the other document and they needed that other document. We got a statement that was certified by a supplier indicating that they indeed made those supplies to the taxpayer, but they no longer have those records because they went outside that window. And this was a time when we did not have these facilities available. If they were more expensive. But even then, the regulator wasn't willing to listen to it. However, when the matter got before the Tax Appeals Tribunal, we were able to settle it with the legal team at URA, because it was really unreasonable in terms of whatever it is they were requesting for. So what I'm saying is, whereas there is a need for dissemination of information to taxpayers, there is also need for URA to also conduct internal sensitization of all the tax officers from top to bottom, so that instead of having to go over and above an officer so that I think I might get fair treatment from a manager, or now I need to go to the commissioner to be able to get fair treatment. If from the word go, the officer is familiar with these tests, they understand the threshold that potentially the tribunal will utilize to review their case, it becomes quicker and it reduces any disputes that might happen.
All right. Thank you, Emma. Lucy, any recommendations?
So for me, I just have two recommendations. I'll just give two recommendations. The first one is clearly defining or stating what exactly is new information, what exactly is willful neglect, what exactly is gross neglect. because as the law is now, we have left it to the courts of law to determine that. And as the KHD case is now, I think it is law at the moment. And you will find, because of that, there will be a bit of uncertainty, because we'll keep on relying on the rulings of the tribunal, which could change at appeal. So what exactly happens to the previous period where the taxpayer actually relied on a given ruling? So for me, I think it's very important to clearly define those terms, and that can be included in the law as is. The other one, it's a recommendation from the administration of tax point of view. And it's about streamlining and, for lack of a better word, consolidating audit teams. The business of having different people or different teams auditing the same client on separate tax heads, I think could be dealt with. And that is from a point of view of it would be beneficial to the Uganda Revenue Authority, but also to the taxpayer. Beneficial to the Uganda Revenue Authority of if a team comes to me as a taxpayer and it's auditing withholding tax, and I provide this information. I've provided it to URA. I've not provided it to that specific team. So if URA comes back, let's say 5 years later or even 4 years later, and it's telling me this is new information, I will claim it's not new information because I provided this information to you. And so I think from an administrative point of view, the Uganda Revenue Authority could look into that so that they do not have segmented teams dealing with the same taxpayer and dealing with different tax heads. Yeah, thank you.
Thank you, Lucy. Alex, I know you come from the regulator, but considering you had a couple of benchmarks, I'm sure you have some good ideas to recommend to our policymakers.
Well, Emma seemed to be suggesting that the regulator needs much more training. Yes, it's not far away from what actually the regulator also thinks, because the budgets have been done and there's a lot of training ongoing, really. But you see, it's not a one-day thing. It's going to be something that is gradual, because as you train others are also leaving. So if you have a high turnover of employees leaving, then you're losing. Some of them are technical, they are leaving. Others are joining you, they're also technical. So you have a bit of either balanced or unbalanced. So these things are going to be there, but the training is there. The training is ongoing. But the other thing that tax authorities do around the world, if you've heard of ATAF, is trying to tell tax authorities to actually do a lot of sensitization for taxpayers. Because if you got a big population, for example, in Nigeria that is tax aware, then some of these things don't actually come up in courts. They're going to be now fighting over different things of amounts, but not necessarily that I didn't know or that I was out of time. Those will not come up simply because you have a sensitized and an alert population that is aware of its rights, tax-wise. But also the user ministry, which is Ministry of Finance, probably is much more concerned about the amendments that they come up with. Yeah. So the amendments must be intentional, meaning it is meant to spear or prick at a particular point. So if it is intentional, it must be felt, and it must be something that is going to give certainty to investors, certainty to taxpayers, certainty to the people who want to spend their money in Uganda or want to spend it outside Uganda. So if you have something that is not necessarily defined in the law, it's not that Lucy is saying everything must be defined in the law, but if you look at the codification in Nigeria that is talking about new information, it actually gets to tell you what new information might be. Or the discovery of new information. What is discovery? Can you discover information? Yes, you can discover information, but can you discover new information? So if, for example, one of the departments in URA, like they have given an example, has the information, it has been seated with them in an audit, probably it was about an investigation. And they are aware. They did an investigation, they have had the information. Later, they come to that particular taxpayer and they're doing a usual audit. And the taxpayer goes like, no, that information you people already have.
Yeah.
The excuse cannot be that, oh, this one was by a different department and now we are new. You get?
Yeah.
It cannot be that way. So information to the tax authority is information to the whole tax authority as a whole.
Yeah.
And there's a case in Kenya that actually, the Commissioner General in Kenya tried to argue that kind of excuse because the tax investigation department had carried out an investigation. They kept the documents with them. Later, they come back after 2 years to do a normal audit for these particular taxpayers. And they were telling them, we gave you that information already. So when they request for information, further information from the tax authority, the taxpayer said, I'm not giving it to you because we already have it. The problem was the record keeping within the tax authority because they could not trace it. But the chap had a receipt, a stamp, everything was there that they had it. They just couldn't locate it. Now even the assessment becomes a problem for you to raise and you be able to defend it. So the other thing is actually making sure that the tax authorities can do it, have also a good record keeping system in place, in that it is easily referred. You can easily make a referral to it, and also inside within the tax authority, the departments are able to actually communicate timely and cautiously. So if a certain department did something and someone, also taxpayers are very brilliant lately. They write a letter and probably take it to a certain assistant commissioner A. After that, they write another letter to the other one, and then write a third letter to the other one. Now, all these three departments are not talking. And they will also, because they have to reply, they are going to reply to these taxpayers, to the same taxpayer rather, differently. So the taxpayer will later come up and see who has given me a favorable one, this one. And that's the one he comes waving, And yet the other one is saying something different. For example, for rulings, they can write for a ruling, they want a private ruling. That's why UR has decided to systemize the whole thing of private ruling. Because before, you could get it from like 3 different places. And now when he gets one that is favorable, he tells you there's this one here. Goes around, flashing around that. And there are several cases that have discussed the same thing about that. Yes.
Yeah. Thank you, Alex. Those have been very, very great insights. Thank you so much. Just to shift the gears a bit, because we said we'll be discussing 2 cases, would like to now dive into Premier Recruitment Limited versus URA that discusses what amounts to an exported service. Yeah. So, Emma, could you please walk us through the facts of that case? What were the issues and what was the ruling of the tribunal?
Okay, thank you, Vanessa. So, Premier Recruitment Limited versus URA is a case about what amounts to an export of a service and the relevant tax implications of that. So, Premier Recruitment is a labor export agency in Uganda, and they've been doing it for a while. So, they applied for a VAT refund, for a value-added tax refund from URA in respect of the input VAT that they had incurred over time. So, at the point of applying for the VAT refund, it triggered an audit from URA in a bid to verify the information that that the recruitment company had provided to URA. So during the audit, 2 things happened. The first thing was that URA acknowledged that they were entitled to about 167 million shillings in refunds, and that on the other hand, they were not able to verify, Uganda Revenue Authority was not able to verify an amount of about 30 or so million shillings on the basis of the fact that they couldn't establish whether indeed the suppliers, the vendors, had made supplies to them. So, because of the unverified amount and because of the unverified portion of the tax, what ended up happening was that URA then halted the refund process until they could verify that position. That was on the one hand. And secondly, URA further looked into the VAT returns that Premier Recruitment had been filing, and established that it had been sending Ugandan labor abroad, for which Premier Recruitment argued that it was an export and therefore it was charging tax at 0% because it deemed it as a zero-rated service. On the other hand, during the audit, the Uganda Revenue Authority had a different interpretation. It had a differing interpretation that the labor externalization was indeed, while it did happen and they were sending personnel out of Uganda, it was not necessarily an export, but rather the supply was local and therefore standard. So the interpretation was that the externalization of that labor was performed and consumed within Uganda. And for that, Premier Recruitment should have charged a standard rate of 18% and not 0%. And those were the two issues that were presented before the tribunal. The first one, whether Premier Recruitment is entitled to its refund that it had applied for, about 193 million, and also secondly, whether indeed they were liable to pay VAT on the labor exportation they were doing. So at the Tax Appeals Tribunal, they made the same arguments, both sides, and the Tax Appeals Tribunal found that one, like they had decided over and over again, it is not the obligation of the taxpayer. It is not the obligation of the taxpayer to verify the existence or non-existence of a supplier once they have provided the Uganda Revenue Authority with the information to support their input VAT. So that has been decided upon over and over again, and it was resounded in that same case. However, they highlighted that where the Uganda Revenue Authority requests for information that in fact supports your position, it would only be prudent for you to give them that information. So as an example, if they requested for the address of your supplier and you have that address, please go ahead and supply that address. But simply because the vendor had not remitted the corresponding VAT is not ground enough for the regulator to withhold or deny an input credit that was duly obtained by a taxpayer. Now, on the second issue, which was on the externalization of labor, and this had always been a gray area as to when a service is deemed to have been exported, because the position which the regulator seems to have taken for a while has always been that to the extent that the place of supply is in Uganda and that I supply the service in Uganda, irrespective of where the consumer of that service is, that service is deemed to have been supplied in Uganda, which would then attract a standard VAT rate of 18%. But there are a number of principles and a number of international statutes which have sort of clarified that position, because the manner in which our law is worded, again, leaves a bit of a gray area as to what that amounts to. So the tribunal relied on what we call a destination principle that my colleague Lucy will delve a little bit into, that the jurisdiction that has the taxing rights over such a scenario would be the jurisdiction in which the consumer of the service is located. So in this case, the taxpayer had provided evidence to show that the consumer of that service was in Saudi Arabia, where the personnel were being taken, and therefore they had produced contracts to show that this is where the consumption was being had, and therefore on that basis, whereas the company making the supply is located in Uganda, the consumption of that service is actually located out of Uganda, for which then that amounts to an export of a service. And the Tax Appeals Tribunal agreed with them on that front. So those were the two rulings in respect of the two issues.
Thank you, Emma. Just to extract from your submission, Lucy, around the world, when it comes to VAT, like he mentioned, there's the destination principle, yeah, What does this mean, and what does it mean in light of exported services? Could you break it down for our dear viewers out there?
Okay, so the destination principle is just an international tax law concept. And it's to the effect that when it comes to value added tax or taxes that are equivalent to value added tax, and the value added tax would have been paid on a cross border transaction. So we are looking at two countries. The rights to tax that transaction from a VAT point of view, or the rights to collect the VAT on that transaction lies with the country in which the consumption is being made. So it lies in the country whereby the person is using or consuming that service is. So for example, Uganda and Kenya, if let's say I am providing tax advisory services to someone in Kenya, and those tax advisory services are going to be used by that person in Kenya for their, to, let's say, make a decision about an investment. In that case, then the right to collect value-added tax on that transaction is then left to only Kenya. And the whole point of this principle is to ensure that there is no double taxation. Because if on that transaction, Uganda is collecting value-added tax, and then also Kenya is collecting value-added tax on that import, then it means on that transaction, it suffers VAT twice. So, of course, the laws are a preserve of every country. They can decide whether to include that principle or not. And Uganda decided to include that principle in its laws. And that can be seen in the treatment of exported services. And the understanding is that if someone is providing exported services, then those services currently only attract value-added tax at the rate of 0%. That person need not pay value-added tax in Uganda at the rate of 18%. It is 0%. It could be exempt, but currently it is 0%. So that is, in summary, that's how I could explain the destination principle, as opposed to the origin principle. And the origin principle says, okay, value-added tax is supposed to be paid in the country in which those services originate. But currently, Uganda, in as far as export of services is concerned, has taken the destination principle, which was also emphasized in the premier recruitment case. Yeah.
All right. Thank you, Lucy, for that. So just to get a bit practical and from the regulator side, since the underlying concept is where the goods have been consumed is where the tax should be paid. So Alex, how would I practically prove that I have exported a service? Is there a specific documentation that would help convince URA that I've exported this service? How do I practically, as a taxpayer, prove that this service should actually be zero rated as compared to standard rated, a local supply?
Thank you, Vanessa. Well, the principle is not as new as it might seem. It's been around, only that they have not been mentioning the word destination principle, but the courts in Uganda have been applying it without necessarily saying destination principle. But also in our law, we don't have the word destination principle there. But you can see the crafting of the law, it's actually in there. So this, when you consider international VAT, well, international tax, but there's VAT, okay, for international tax. What majorly we one time grappled for as URA on a matter on destination principle was whether to qualify something like OECD, GST guidelines as applicable in Uganda. Now, there are three cases I think one I did with Lucy, was it mixed mathematics?
Yes.
There was a light beverages. There's been Apollo Hotel. Now, those have tried to apply the principle. In all those instances, when you look at the Kenyan law, it is actually gives more certainty than the one for Uganda. Now, in Uganda, for you to have an agreement, for example, an agreement between the person consuming the service who is in another country and you who is supplying the service from Uganda here, there must be an agreement in between according to the regulations of VAT. However, the Ugandan law is still twitched to the UK law, whereby you have to state exactly that agreement where the consumption is going to be. So what taxpayers have been doing, simply because they think, oh, since the law says that I should state where the consumption is going to be, even when they know the service is actually going to be consumed in Uganda, they will tell you the consumption is in maybe Nigeria. You get, simply because the regulation tells them to state the country of consumption. And they think by simply stating that particular thing, then the transaction passes to be one of where the destination principle will save it. But the transactions that are within that web are actually normally very complex. The one for Premier was very simple. When you go for that one of light beverages, it was very complex. And that's why I think the fight will move on and go on and go on. Because if something is going to be done in Uganda right here, and then it takes a whole tour almost around the whole world, then it comes back finally and someone is consuming a Fanta bottle here in Uganda and it has so much sugar, simply because of the research that was done by in the village. And the one Namukade says, they should add in more sugar. This soda is not that sweet. So if the research goes to New York, it goes to Atlanta, it comes back down to Swaziland, and then the soda is here. You can ask yourself, where is the consumption of that good or the service? Because it looks like it is moving all along. Both the service and the good is moving on the entire thing. So that's what URA was trying to argue in that case. But in the instant case of Premier, who's recruiting? Premier is recruiting. To what extent is the recruitment service? When does it stop being a recruitment service? When I tell you now, I've signed for you okay, you've signed the contract. Is that where the recruitment service stops? When someone gets to go to Saudi Arabia and sits there, are they still being recruited? Or they're now starting work? They're starting work.
Yeah.
At that moment, they're starting work. Is it still a recruitment service?
No.
So is the consumption of the recruitment service that Premier is giving? Is it consumed in Uganda or it's consumed in Saudi Arabia?
In Saudi Arabia.
When you start thinking about deeply, actually, you might actually change your answer. You can change your goalposts. Critically, in one of the Kenyan cases, which is also similar to the light beverages, almost the same. The other one was about a Coca-Cola bottle. And the judge in that Kenyan case keeps on asking himself and saying, it's not the fact that when I advertise the Coca-Cola advert on maybe the yard there at Ginger Road, and a young baby looks at it, or Vanessa looks at the advert, that it is going to culminate into that person actually buying a bottle of Coca-Cola. No.
But they consume.
They have consumed the advert because they have looked at it, isn't it? Have they bought the bottle? No.
But
so then you have to ask yourself, where does the service stop? And I think in Premier, that's where the tribunal is failing to actually cut the line. And for any lawyer to sit down and actually argue that case, they have to think a bit differently. It does not have to be normal. It's not to be a normal thought. And it's that kind of whereby you're going to rearrange your thoughts and bring up something that is really novel. Because when you think about it, recruitment stopped where? In this transaction, where did it stop? We have to ask ourselves, does Premier have the Premier Services Limited, does it have the powers to actually have the person they're taking to sign the contract from Uganda, or they sign the contract from the other side?
Yeah.
Does it mean that Premier, when Premier outsources you and puts you on a plane, that actually the recruiter, whether the Saudi Arabian person is going to simply accept as you've been brought, or he can actually say, no, take him back? So in the instance where he says, no, take him back, where is the consumption?
Non-performance of contract.
No, it's not non-performance of contract. I've done my recruitment service as Premier. Because the moment I recruit you, we must understand that agreement that they have. That do I take everything that you bring? Or I can actually refuse. All these things are not talked about in the case, so we can't know. Yes? So if we stopped at the point where I have recruited as Premier, passport you have, everything check, you've done your tests check, health check, perfect. When you reach Saudi Arabia, is this, I'm not going to call it a good,
No,
I mean the
it's a
person.
service.
Is this person still in the play of the service of being recruited? No.
Yes.
We are going to start work. We have reached the workplace at that moment. Recruitment ended long time ago.
But you see, Alex, you can't look at it in isolation.
Yes.
Yeah. You also have to look at who are they recruiting for?
Yes.
What's the purpose of
When
the
does the
people
contract,
recruiting?
when
Yes.
is it deemed to be performed?
Exactly.
That is brilliant to think about it that way. But going back to the other example I've given you of the Coca-Cola bottle, yes, whereby Coca-Cola wanted to push its brand in Kenya. How does it push its brand? It advertises. But out of some of those adverts, actually people go and buy. Others don't. Not that whenever I see it on being played on a certain TV, I'm going to buy the bottle. No. Now, recruitment being done by Premier, there is a process that they pass through. Where does that service stop? When does it end? When he gets the person to do the work? Or when actually he's told that I've gotten this number that you asked for and they're still here? That's something the court did not talk about. That's something the parties didn't go into. But when you go to the other case of allied beverages, it's comparable. The sequence of doing the concentrate and making it from Swaziland, it coming back to Uganda and people actually consuming it, when Century Bottling does the bottling, one can stretch it and say the research that was done about how sweet the Coca-Cola is, down to making the concentrate, the research and back and forth, consumption is in Uganda. You can stretch it that far. Well, it's just food for thought. I was just trying to think out aloud, but I think some of the documents that you might need, definitely the agreement is important. Then how are you paying? How are you paying? If the payment is by bank, all those have to be, and who's paying? The who and who they are paying to also is important for you to establish the transaction to be actually that it is one of destination principle that is falling out of Uganda and it's an export of services rather than an import. Because the two tend to, if you think about an export, then you are going to argue that it's an import of services, whichever way it can work. Like in mixed telematics, they were not here. Everything is done, I should say in air, because they were just tracking cars around Kampala.
East Africa.
In East Africa, they're tracking cars, but they're tracking the cars from South Africa. So if you have your car and it's lost and it's misplaced, you simply call and tell them, locate me this car. The chap who's locating it is in South Africa. He was consuming the service of location. Either one was consuming it here. Well, in that case, we didn't get that far, but I think it's still a lucid place.
Yeah.
And any judge can decide it whichever way, whichever reason they give. But I think what is very interesting is that case of Kenya, the one for Coca-Cola, the bottlers. It's amazing. The judge asked questions that he never actually himself answered and made a certain conclusion, which was also a well-concluded thing. But he didn't answer his own questions that he set up, simply to show you anyone can get to any other side about this thing, as long as the facts are there and the detail is there. What is limiting us in this case is that Premier, some of the facts are not there, like the ones have been also, some questions have been asked.
Yeah.
Sure.
Thank you, Alex. So I think that brings us to the end of this thought-provoking exercise that we've had. The discussion has been quite insightful. And I guess it gives us food for thought. Yeah. We've discussed two pertinent rulings, their impacts on your business. And we want to offer a heartfelt thank you to our dear panelists, Emma, Lucy, and Alex. Thank you so much for honoring us today and providing very valuable insights to taxpayers and policymakers out there. So thank you, dear viewers, for tuning in. If you found this episode very helpful, please subscribe to our channel, like and share with a friend, and let's build Uganda together. Thank you.